Good morning, everyone, and thank you for joining our tax planning webinar. We have some great panelists here today to present all of these tax planning updates for 2023 going into 2024. We've got Ed Thaney, our managing partner, Alex Bianchi and Edgardo Mercado, two managers at the firm. They're all going to be presenting throughout the webinar. If anybody has any questions, please feel free to type them in the chat box or the Q&A box throughout the webinar. We will get to them either right away or at the end, depending on where we're at in the webinar, but we will get to your questions. So I'd like to kick it off to Ed Thaney to get us started.
Thank you, Morgan, and welcome everybody. Thanks for joining us today for our tax planning webinar. I am the managing partner of our parent company, which is Thaney Associates CPAs. We're a firm. We have offices in New York and Florida, 5 offices in total. We perform work for clients in over 36 states, currently for tax and accounting, auditing, and many other accounting services, especially today, tax planning. We also own a bookkeeping company called Elite Business Solutions. We offer virtual bookkeeping and CFO services for small businesses with accounting throughout the country. Additionally, we own a franchise called Trans World Business Advisors, where we help clients that would like to buy or sell a business. We have certified valuation analysts on staff providing valuation and due diligence work. Biz Collections is another entity that we have for third-party debt collection company assisting with bankruptcy, alternatives, and debt restructuring. And last but not least, we own Clear Choice Capital, which is a third-party small business loan agency helping to facilitate SBA loans, equipment loans, lines of credits, and other small financing needs. It's coming into play now more and more with the interest rates getting up there a little higher and restructuring a lot of internal business debt. I know it's a lot to swallow, so if anyone feels like they'd like to get more information on anything we just mentioned, please feel free to follow up. We offer a complimentary consultation for anyone attending this webinar. So please feel free to give us a call to set that up. And I will now let Edgardo and Alex take over and begin a deeper dive into our tax planning webinar. Thanks again, and please enjoy.
Good morning, everybody. Thank you again for joining our webinar. My name is Edgardo. I'm a CPA and a manager here at Thaney Associates. So, what is this presentation going to be about? In summary, you will learn about the most important changes for 2023 income tax and deduction regulations. And as you can see, we're going to be talking about the 2022 and 2023 standard deductions, tax brackets, capital gains tax, retirement plan contribution limits, gift tax, child tax credit, and child and dependent care credit, residential clean energy credit for 2023, electric vehicle tax credit, and other tax deduction and limits. At the end of the presentation, we're going to be having a session for questions and answers, but please feel free to interrupt us at any time. Send a question through the chat, and we will be happy to clarify any concerns that you have, okay? So, the first topic in this presentation, the standard deduction. This is a deduction that the IRS imposes based on your filing status. So, filing status is if you're filing single, married filing jointly, married filing separately, and head of household. This standard deduction is an amount that is going to be deducted from your taxable income. Those amounts are the ones that are in the table, and as you can see, they have increased from 2022 to 2023. And you're going to see these increases all throughout the presentation because the IRS adjusts the amount according to inflation, okay? So keep in mind the standard deduction, but I'm going to talk about the itemized deductions. So this is another type of deduction that you can take, and this one is a little bit more complicated, and it's going to be the sum of the medical and dental expenses, other taxes like real estate and state taxes, mortgage interest, and other gifts made to qualified charities, and also casualty losses. But here's the catch. If you take the itemized deduction, you cannot take the standard deduction. And you have to choose one of the two. And of course, you're going to choose the higher one. But I emphasize on this because, for example, we have clients that they submit the mortgage interest. And then when they see the final return, they say, hey, but why didn't you deduct the mortgage interest from my taxes? And that's going to be because if they only have the mortgage interest and it didn't go above the standard deduction, then of course you're not going to take only the mortgage interest. So let me show you here the previous table. So for example, if said client submitted mortgage interest below $13,000 for 2023, and he was filing single, then of course we're going to go with the standard deduction. We're not going to take the itemized deduction. So take that in mind if you have real estate taxes, mortgage interest, medical expenses. Keep in mind that if it's not higher than your standard deduction, then of course we're not going to itemize those items, okay?
Let me point out one other thing back on that Schedule A, Edgardo.
Yeah.
If you see that, so the total of that has to be, let's say, a married filing joint return, $27,700. The taxes part is limited to a maximum of $10,000. So you can have state income tax of $30,000, real estate taxes of $20,000, but you're only limited to 10 under the taxes. The interest has a limitation now on principal residence interest on a mortgage that you can only pay interest up to $750,000 of a mortgage. So we do have some taxpayers that may have other rental properties. They may have real estate inside their corporations, and we try to reallocate some of these mortgages around. So you may want to look at that if you have a mortgage on a principal residence in excess of $750,000. And the other one that I will point out throughout this webinar is on the charitable gifts. Many people don't have a mortgage. They have the $10,000 max. And then the only thing they give them more than the $27,000 would be $17,700 in contributions. If you by chance have a small business and you're doing your charitable contributions out of your S corporation, it would be flowing through to this. And if you didn't have that, you would be using the standard of $27,000. So what we're trying to point out to a lot of small corporations to see if they could reallocate their charitable gifts in other fashions, like advertising to a church for a church school bulletin or something, and making that a marketing strategy as opposed to a charitable contribution where you could possibly pick up and use the standard deduction and not have to use the itemized deduction.
Okay, next topic, going into the tax brackets for 2023. As you can see, if you compare 2022 and 2023, you're going to see that the tax brackets have increased. Again, this is because the IRS is adjusting for inflation. As a result, this means that the tax brackets are wider And what this could possibly mean is if your income stayed about the same or increased just a little bit, there is a higher chance that you're not going to go into a higher tax bracket. We're going to be sending out the PowerPoint and a PDF at the end of this presentation so that you can have an idea of what your tax bracket is going to be for 2023, okay? Capital gains tax. Okay, so this topic is going to be very important for those of you who are active in the stock and trading markets, and also for those of you who have multiple rental properties. So what are capital gains? Capital gains are generated from the sale of stocks, bonds, cryptocurrency, and real estate. Now, the tax rate is going to depend on how long did you hold the asset before selling. If you hold a capital asset for 1 year or less, any gain from the sale is considered to be a short-term capital gain, and it's going to be taxed using the ordinary rates from these tables in here. Now, if you hold that asset for more than 1 year, the gain is going to be treated as a long-term capital gain, and it's going to be taxed at a lower rate, which are the ones that you see in here, 0%, 50%, or 20%, depending on your taxable income. And the long-term capital gain tax brackets are usually set up so that you will generally pay lower taxes, okay? So this is very important for you guys if you have a lot of investments, because it's good for you to always keep in mind that if you hold those assets for longer than 1 year, your taxes will be less. If you sell those assets before the 1 year mark, your taxes will be higher, okay? Retirement contribution limits. Okay, this one is going to be important for those of you who have large disposable income at year end. There are two types of retirement contributions. You're going to have pre-tax contributions and post-tax contributions. When you make pre-tax contributions, these are going to reduce your taxable income at year end. So for example, if your income is going to be high for 2023, it is recommended that, and if you have disposable income at year end, it is recommended that you make pre-tax contributions so that your taxable income goes down, and you make these contributions to any retirement account. One example is the traditional IRA, and you're going to reduce your taxes, and possibly you could also get into a lower tax bracket because of that contribution. Of course, keep in mind that any of these contributions that you make, there's a limit of when you can take them out. Usually, correct me if I'm wrong, Ed, but it's 55, I believe. So you have to wait until you can retire so you can take these distributions out, okay? The other type of contributions is post-tax contributions. This will not reduce your taxable income at year end, but when you take out the distribution, they will not be taxable. So if you see in the news that they're saying, hey, tax rates are going to go up for 2024 or for other years going forward, this is a good type of contribution that you can make because it is not going to be taxable when you take it out of the account. Okay, an example of this one is going to be you can see it at the top of the table, the Roth IRA. So again, traditional IRA is going to be a pre-tax contribution, and Roth IRA is going to be a post-tax contribution. Again, you can see that the amounts went up from 2022 through 2023. Again, because the IRS is adjusting for inflation, okay? And the deadline for contributing to 401ks, it's going to be December 31st. But if you want to invest in traditional or Roth IRAs, it's going to be April 18, okay?
Let me add a couple of things before I go back to that, Edgardo. First, again, I'll do my spiel on tax planning, and even went back with the capital gains. We do a lot of this time of the year meeting or just communicating with all your wealth advisors, investment advisors, making sure that your gains can offset or losses can be exercised. And as Edgardo was mentioning before, with real estate too, whether we're going to be going into, which we still do with 1031 exchanges, where you could possibly avoid the gain on a sale of rental property, but we do all that between October 1 and December 31 of the year. But to answer the question on distributions, it's 59 and a half is the age of taking distributions without a penalty, except there's many exceptions to that. If you've decided to sell and retire or stop working at age 45, you can start taking distributions without being penalized, but you're going to have to take a minimum distribution at that point from there on in at the same amount over your life expectancy until you turn 59 and a half, then you can do anything with it. These are your basic business plans. With our planning, we look at other people, with other entities and how they're doing. There's some more favorable tax plans you can get into under the 401k plans. One, we call it a new comparability plan. It's really an oxymoron because it's not new and it's not comparative to anything, but it really allows the small business owner to create classes of employees, officers, managers, regular employees, and contribute as what you see a lot with the minimum of 3 to 4%. It may be 5 to 6%, but the owners can target up to 25% of their compensation for it. And you can have management anywhere between that 5% and the 25%. It's discretionary, but it's favorable to the small business owner. There's also other plans we're getting into are very aggressive plans, but they're all accepted under the IRS. One is called the cash balance plan, where you could have a W-2, you see that maximum allowable compensation of $330. I think if you have a compensation, I think approximately $250,000, you can have a deductible pension for yourself around $275,000 if you have that type of cash. So that contribution limit of $66,000 is totally not necessarily true if you get under these plans. I think that's all I got to say on the retirement contribution. Thanks.
Again, if you have any questions or concerns, feel free to send us any questions through the chat. Now I'm going to leave the presentation to Alex. He's another manager in our firm. So Alex.
Thank you, Edgardo. Like you mentioned, my name is Alex. I've been a tax manager here at Thaney Associates for the past couple of years. I started at the firm in 2017 as an intern. I work mostly with tax planning, business and personal tax services, and valuation services. So the first slide we have up is about gift tax and the amount of annual limit for 2023. What gift tax is? It is a federal tax on transfers of money or property to other people who are getting nothing in return or less than full value. The gift tax limit in 2023 is $17,000, up $1,000 from last year, which was $16,000. The amount is called an annual gift tax exclusion. It is the maximum amount you can give to a single person without reporting it to the IRS. If you gift more than this sum, you must file a federal gift tax return in 2024. The exclusion is per recipient. So it is not the sum of total of all your gifts. That means, for example, you can give $17,000 to your cousin, to your brother, to a friend, a neighbor, and so on, without having to file a gift tax return. If you exceed the annual exclusion, you will have to notify the IRS. However, You still might not have to pay any taxes unless you go above and beyond the additional lifetime gift tax exclusion of $12.92 million. An example of that would be if you give, let's say, your brother $50,000, you'll use up your $17,000 exclusion. You will have to file a tax return for the extra $33,000, but it will just count against your lifetime gift tax exclusion of $12.92 million. So you won't have to file any taxes on that. The person receiving the gift will not have to file any taxes or report anything on their tax return. Couple of tax credits. The first being the child tax credit is $2,000 per child up to age 17, of which $1,500 is refundable. The annual income must be less than $200,000 for single filers or less than $400,000 for filing joint returns. For child and dependent care credit, you may claim this credit on qualified child care expenses up to $3,000 for one child and $6,000 for two or more children. The max credit is 35% of expenses if you earn under $43,000, up to $1,050 for one child and $2,100 for two or more children. And if your income is over $43,000, it is 20%. The credit is 20% of the expenses, which is $600 for one child and $1,200 for two or more children. For what qualifies as dependent care for this credit would be a nursery school, pre and after school care, a daycare provider, babysitter. You just have to make sure you record all your expenses, you keep track of it all. They should give you a file or a form at the end. You'll just need the address and their employment identification number or social security number if it's a babysitter. Who doesn't qualify is if you're putting your kids in tutoring, a sleepaway camp, summer school, or anything you are sending them off for entertainment throughout the day. Those do not qualify as child care. And this is a non-refundable credit. One other credit new for 23 is the residential clean energy credit. It is the installation of solar, small-scale wind, geothermal heat pumps, home battery storage, and fuel cell energy systems. Each installation is subject to its own set of eligibility and criteria with their own maximum credit limits. However, we find that the average range is 30% of the total cost of installation that will be received as a credit. If this credit is greater than the taxes owed of a taxpayer in a given year, the excess credit will be carried forward into the next year, and you can use this credit towards your, that's 2024 taxes. The electric vehicle tax credit for 23. The Inflation Reduction Act of 2022 changed the rules for this credit for vehicles purchased from 2023 to 2032. It is now a $7,500 non-refundable tax credit available to individuals and their businesses. It needs to be a new qualified plug-in or fuel cell electric vehicle. To qualify for the credit, it must be purchased for your own use, not for resale, used primarily in the U.S., and your modified adjusted gross income may not exceed $300,000 if you are married filing joint return, $225,000 if you're head of household, and $150,000 for all other tax filers. Another credit is the EV charging station in your home. So if you add in a plugging system with your Tesla or EV car, the max credit is $1,000 or 30% of the installation cost if it's less than $1,000. If you want to know if the vehicle you are purchasing or the vehicle that you have already purchased qualifies, please let us know and we can look it up for you and have the information over to you. There are some tax deductions and limits for 2023. For mileage, beginning January 1st, 2023, the mileage rates for using a car, van, pickup, or panel truck has been increased to 65.5 cents per mile for work use. For charitable mileage, allowance is 14 cents per mile. The meal deduction for 2023 is 50% of the cost. And the maximum HSA contributions for 2023, for single coverage, it's $3,850. For family coverage, it is $7,750. And if you're 55 and older, there's a catch-up of an additional $1,000. And these contributions can be made on or before April 15th of the tax year. The Secure Act 2.0, it required the minimum distributions age increase to 73 in 2023, and then it will increase again to 75 in 2033. The penalty for failing to take an RMD will decrease to 25% of the RMD amount in 2023 from 50% currently, and drops to 10% if corrected in a timely manner for our IRAs. Starting in 2024, RMDs will no longer be required from Roth accounts and employee retirement plans. The catch-up contributions will increase in 2025 for 401k, 403b, governmental plans, and IRA account holders. Defined contribution retirement plans will be able to add an emergency savings account associated with a Roth account. Ed touched on this briefly, but the charitable contributions, the individuals who do itemize can apply up to 60% of their AGI for qualified contributions made during the 2022 and 2023 tax year. Contributions must be made to a qualified organization. That would be your churches, any charities, and any organization who has a 501c3 designation. If you have questions or concerns of whether the charity or organization you are sending money to qualifies, please let us know and we can get that information over to you. For qualified charitable distributions, they also count as a RMD. You must be at least 70 and a half at the time of request. Funds must be transferred from IRA to a qualified charity by 12/31. The maximum exclusion for a qualified charitable distribution is $100,000 for taxpayer and $100,000 for spouse on a joint tax return. Any qualified charitable distribution over $100,000 counts as income and is treated like a regular distribution. If you are filing as a C Corp, the maximum allowance deduction is limited to 10% of a corporation's taxable income. And now I'll turn it over to Ed to talk about our tax planning services and how you can benefit.
Thanks, Alex. One note on Alex's C Corp 10% contributions, those that are not used, if they're limited by the 10%, are allowed to be carried over to the subsequent years. So you can get those in the next years. Our tax planning services is all about what we stand for in what we do right now. Again, we call it a dress rehearsal. We do it with most of our substantial clients, but not really substantial. Basically, anybody who has a small business related to themselves. Many companies are S corporations. We try to make sure they're within the safe harbor with their compensation compared to their net income. If they don't have that type of compensation that they're paying Social Security on, it opens the door for an employment tax audit, which is with the IRS. And they try to come in and say, oh, your net income from your S corporation is subject to self-employment tax if you don't meet the guidelines. Our guidelines are about 25%. So if you have a $50,000 salary and a $350,000 net income on the business, a sub S, that would be 400. 25% of that would be of 100. That would be at risk with the government. If it was at 100,000, that's what we do at tax planning to make sure something like that is would prevent our under the radar red flags with the IRS. We also actually with the dress rehearsal give different options of things that we can do. is some of the stuff that we were talking about before with pension plans, profit sharing plans, acquisitions of assets. There's some other stuff I'll get into later with the business services, but prepaying expenses and deferring of income if you're cash basis, conversions of cash basis tax reporting to accrual or vice versa, even getting into things like converting to percentage of completion or completed contract if you're a construction company, services company, or have contracts that are in existence of over 2 years where you can defer the tax payment of the profit on a job. But what we always say with we get into succession planning, a great tool for retirement to seeing where you stand. Again, increasing the retirement contributions into there, doing a succession plan and perhaps sale of the business to family members, to key employees. We get into all of that before the end of the year because there can be bonus situations where you could be paying key employees. Some of those key employees could have pretty good health insurance or life insurance policies on the owners, which would be a great estate planning tool. So when we always say on January 1st of the next year, all we do is become historians. We can't do anything. We do it all now, and it has to do with all of the available deductions and credits that we could be taking for you and making sure everything is in order in time. That new comparability plan and that cash basis retirement plan, the more aggressive plans, I believe if you don't have an existing 401k plan, has to be established by October 1, which is this Sunday, or Monday would be the next business on that. So I think that's the importance. Many of our clients rely on the planning. The tax returns for our work the war is already over. We've done our job. We give comparisons of where we were compared to our planning, and the investment in doing that tax plan is well worth the tax savings, which we do show to every client, being the business and the individual. Thank you. And again, with the businesses for this year, these are the things that we would, have, again, being cash basis, making sure you've got the health insurance. A lot of big things with employees now. Some people have limitations. I always like and encourage that they cover a certain policy, but with a dollar limitation, not the percentage of it, but it can be another way of giving to the employees by paying more share of the health insurance if you can. The retirement, I've said before, is the various plans to analyze. Many of them have to be set up. Most of them have to be set up before the end of the year, as Edgardo had led to about contributions, but some of them have to be set up. A 401k plan, I believe, has to be set up by this Sunday or Monday, too. Qualified business income deduction is something that we take, and it's based on, right now, it's 20% of the net income from your either LLC, Schedule C, or S corporation. And the car for the business purposes, along with the depreciation expense. Edgardo got into the increase of the standard deduction we use for businesses. But the big thing with the tax planning right now is acquisitions of equipment or heavy cars, SUVs, anything with a gross vehicle carrying weight over 6,000 pounds can be written off 100%. And that amount should be weighed about taking the standard mileage rate. If you write it off 100%, then we call basically itemizing all the deductions of the car, which is the insurance, the gas, the repairs, the any of the changes, tires, equipment, parts, and all that. That can be a huge deduction at the end of the year. We've had some $135,000 Escalades being written off 100% by the end of the year. You may have it financed over 5 years. You just got to keep in mind those payments over the next 4 years will not be deductible except for the interest on it. And again, that's along with financing the cost of businesses, where we mentioned before that you may want to do some financing of the acquisition of assets like that because they'll earn itself over the payment period. Same thing with equipment. And it could be an avenue of looking at of deferring some of your personal debt where that might be limited with that mortgage interest. And again, that's the gist of most of the stuff about using your cars or personal property inside the business. The home office deduction today with all the virtual people, it's been more and more accepted. We do not recommend depreciating the house, even though we have some businesses fully taken down their outside office and moving to their own residences. We're still trying to keep that away from the IRS in that your lifetime or your personal residence exemption would disappear for a percentage of the house we write off. So what we do take is then a percentage of the operations of the house, which could be real estate taxes that you'd no longer get a deduction for because of the $10,000 limit. The interest on the mortgage, which doesn't matter because you would get it on the personal, but that percentage of the office, be it 10, 25%, it would be the repairs, the landscaping, all the upkeep, utilities of it. And it comes up to a pretty good deduction of taking that allocation on your business, which would be through your S corporation. We create loans to shareholders as a reimbursement for that, or on your C corp, on your Schedule C or LLC, which would be a direct deduction from the bottom line, which saves you in self-employment tax. A lot of these things, again, during planning are examined, analyzed, discussed, and we decide then before the end of the year. So the sleep at night issues it takes care of with the tax planning and going through all the stuff. I don't know how many of you have woken up in March or April when your accountant said, get ready and pay $100,000. You won't do that with us if you go through the plan. Thanks. And again, these are our other services that we have, a range of them. Again, we're trying to be, and we are proactive as opposed to being reactive here. And the big thing here is we do have that succession planning. The succession planning, really, what is it all about? It's all about your successful business, your successful investment strategies that you've done along the line, which it coincides with an estate plan. And there's, with the succession planning and all that, we can get into other plans with the businesses. One other thing I forgot to mention under the business deductions is we're getting heavily involved right now with issues of maintaining and keeping employees. And they have some, under certain sections of the IRS code, there's deferred comp plans that are pretty easy to do and can be designated to individuals. And the good thing about it is it's a win-win situation. We're doing it now with a dental operation right now where there's a new associate coming in and not sure they want a little more to stay. And what we're doing is this comp plan is a 1099 compensation to this associate. And let's just say if it was $1,000 a month, it's $12,000 a month deductible to the business. And it's a 1099 to that recipient who will have to pay income taxes on it. That $12,000 payment is going into a life insurance policy. that's building quickly because of the age in cash value. And that person would own it. However, the income tax liability on that would be self-employment tax and income tax. Let's just say it's $5,000 a year. The business then loans the $5,000 to the employee each year for the taxes, which will be waived on the exercise and the cleaning out of the cash value of their life insurance policy. In the one we're doing now is a 10-year period. The cash value will be worth more than the money we put in it. So $1,000, $12,000 a year on the cost after 10 years would be $120,000. It's estimated to be about $150,000. Now keep that in mind if you did it at $5,000 a month. If the person stays, they get the cash value. If the person leaves beforehand, you have a vested interest in that policy because of the loan you're giving it to that employee. It's a little confusing, but it's win-win. You're getting a deduction up front for a deferral of income down the road for this person who has a right to it, except you're going to get reimbursed for your investment on it. So it's a pretty good tool. We call it golden handcuffs to try to keep key employees that you don't want to leave you and may not be interested in having a piece of the pie or an ownership. With the ownership issues we do with the planning too, with valuations for the succession planning, we do valuations of businesses and we can carve out 1% to a key employee. Range of bonus situation where they're paying you for that 1%. You have a bona fide agreement and you go into a buy-sell agreement with them with a formula with giving those key employees right of first refusal on buying the rest of the company if that's what they got in mind. Just different games that you can do to try to keep employees with you. And we do a lot of facilitating with that, explaining it to people, and trying to get people on board with that. So keep that in mind. Again, that's one thing that we do throughout this next 3 months with the year-end planning.
All right. We've got a couple of questions that have come through. So meanwhile, if anybody else has any questions, feel free to type them in and we'll get to those after these first couple. First question is, if I contribute the most on my voluntary contribution, how much can my employer contribute?
Good question, because it's a little confusing on what we're saying with the different the different charts that we have there. Edgardo, can you go back to that pension chart? And it depends what plan you're in. And really, like the first one, there's nothing with the IRAs. The simple IRAs does have some kind of limitation. I believe it's $66,000 or so is the 401k and the SEP IRA. That's the total compensation. So if you look at the 401k and you're over age 50 and you voluntarily put in $30,000, which is the 22.5 and the 7,500, the maximum your employer would be able to do is $36,000. And again, there's different plans they could be putting into. Like I said, the new comparability plan, that's almost like a bartering or bargain negotiating thing, because you can get in anywhere from the minimum to the maximum, and the maximum is 25% that they could put in of your compensation. But depending on how much you put in, again, that would be the $30,000. They could not go over $36,000. The total cap for voluntary and employer contributions for 23 is $66,000 for the norm, except for those other two plans that I mentioned.
All right, thank you. Our next question is, what are the tax consequences of selling my principal residence?
Well, that's going to be under capital gains today, depending where you're living. I don't even know if it's depending where you're living. Everybody's making money on capital gains in their houses. The major, it depends your marital status. There's an exemption of your principal residence if you're living in the principal residence for 2 out of 5 years, 2 out of the most recent 5 years. We've had people that have moved away and not sold their house and been living in another house for 2 years, but sold their older house within the 5-year period. And so they get the exclusion of the gain. So the gain would be your selling price less all your closing costs, including commissions, compared to your purchase price plus all the improvements that you put in it over the years. It could be 3 roofs if it would be, but it would be all 3 of them would be added on. And that difference of your gain, if you're single, the first $250,000 is tax-free, and $500,000 if you're married, filing a joint return. Anything over that would then be subject to the capital gains rates. Of course, you had to be there 2 out of 5 years, so you're in excess of 1 year. So you'd be under those capital gain rates that Edgardo had displayed there of either 0, 15, or 20%.
Okay. It appears that's all of our questions. So if nobody has any other questions, just a reminder, we will be sending out this PDF, and you can find the recorded version of this webinar on our website after today if you wanted to share it with anyone. Otherwise, I will be sending this via email, so you'll have our contact information as well if anyone has any questions or would like to take us up on our complimentary consultation. We thank everyone very much for joining us today and hope to speak with all of you soon. Have a great day, everyone.